Cool. Thanks, everyone. So we have two speakers, and they represent different sides, let's say, to some extent, of the stablecoin industry. We have Charles Jansen with S&P, MD of Digital Assets, and you have Du-Wan Nam, co-founder of StableLabs and a longtime contributor to MakerDAO as part of the growth team, and later on as a delegate. And I think the motion to try and make it spicy is to talk a little bit about the differences between TradFi and DeFi, and in the context of stablecoins, and to dive into how S&P as a TradFi player is looking at it, because they have the stablecoin assessments, and then hopefully use this as a framework for discussing the differences between DeFi stablecoins and TradFi stablecoins, and what it would take for TradFi to adopt DeFi stablecoins. So as a motion, I suggest that we just jump into the fray and start with the motion: S&P's assessment of DeFi stablecoins misses the benefits of automatic enforcement over centralized stablecoins. So in TLDR, code is law for DeFi stablecoins. Charles, what do you think?
I don't think we're missing anything. We're looking at something very specific, which is the probability of depeg. And specifically for DAIs, there was a depeg in 2023 when USDC depeg. And our assessments start with the quality of the asset, which in the case of DAI, I think were 4. So it was like the second worst grade you can get there. Then they will not move one notch down because of the different angles in the governance that could almost get there. But at the end of the day, again, the SSA is not targeting the adoption by TradFi or anything like that. The SSA is probability of depeg. And well, the track record related to depeg exists, and the quality of the asset is what it is, and that's what led to that.
Yep. Actually, even before I begin, I know that most of you guys are probably friendly to DeFi, but Bitcoin might be going to 50K, so we should be nice to everyone, okay? So going back to it, regarding the how S&P assess such, but I think that at the same time, it can be based on many different metrics. So I'm not necessarily think that itself is missing the opportunity per se. And also, there are many different ways to look at stablecoins, right? So beyond S&P, and on the blockchain itself, you can also look at, for example, on-chain liquidity, as well as others. So in that regard, I just kind of think it as okay, another perspective to look into stablecoins. So that has been kind of my thinking behind it.
Yeah, just as a disclaimer, right? I'm not against DeFi at all. My title is head of DeFi because I chose it this way instead of head of digital asset. Now, I think what is really interesting in this debate, and what I'm interested to have your opinion too, is on the actual adoption of stablecoin in both, right? That's the title. I can kickstart with some example of adoption I've seen, and there's a lot of limitations. So if you look at, for instance, the bank in the US, they're not using stablecoin. They cannot really innovate in anything blockchain in the US right now. And when they're doing it, they're doing it mostly in Project Guardian in Singapore. Now, there are a lot of interests. You know that SG Forge is trying to do their own, or is about to launch their own stablecoin. Sorry. As I mentioned yesterday, I've been reached out by several banks in different continents that want to issue their own stablecoin, so there's definitely an interest there. And then define adoption and define TradFi, right? Because there's also all the angle with corporate that are, for instance, issuing on stuff like obligate in USDC while being public company.
Yeah, and then I think that that's a good point. It's I know that we like to think CeFi and DeFi as very different, and of course there are some differences. But we've been more, I'll say, CeFi and DeFi working together, and especially from the user perspective, as well as from the liquidity perspective. Even for example, Maker, a lot of the yields right now have been come from Treasury, which is basically the definition of CeFi in many ways, as well as that they're more, because at the end of the day, crypto market itself is very volatile, as well as has some of the issues. And then traditional market is trillion of dollars, it's much bigger, right? So I do agree that there's a lot that can be explored to how to have more collaboration, as well as the discussions. I do think that one of the parts that we can also maybe discuss in this debate is the part that a lot of DeFi protocols, they want to work with, let's say, CeFi or have the elements of it, but a lot of them, I would say, do not really understand the challenges enough. Because I would say that a lot of protocols, they like to say, okay, real world assets or those aspects are big markets, but both from the legal challenges and others are beyond, I would say, most of resources that those protocols have. So I'm also kind of curious to hear, like, from a more traditional perspective, what would be some of the good ways for those DeFi protocols to better understand how to work with traditional finance?
Got it. So something that's been really hard for us is to interact with DAOs. It's like, I give the example of Maker. It's really, really hard to find the right person to speak with. Also, when you do look at some regulated activity, you typically want to speak with the actual entity. In that case, the answer is, well, the DAO is just code, so there's not really these entities, there's this one, this one, this one. So this complicates things, for sure. Now, some of the DAO are a bit more centralized, which simplify things. I think it's very important for the DAO to have some clearly defined entity or person that is the one that, well, TradFi can interact with and maybe, work within the DAO to bring the different answer. This has not, it was not the case all the time. So that definitely was a limitation.
But so I think this speaks back to coming back to the enforceability aspect. I think one element of TradFi which needs a legal entity is this aspect of a legal counterparty. So you have somebody to claim recourse against if something goes wrong, which is why the choice of a legal jurisdiction is important and why the viability or the history of an entity is important as well. The promise of DeFi is that you can replace this with code, essentially. So what would it take for traditional finance to recognize a world where a DeFi stablecoin can be an API for settlements and doesn't necessarily need a counterparty?
Well, regulation, that's really what is missing the most, like especially when you look in the US. Speaking of big traditional firm and TradFi, if there's no rule to the game, they will not play, period. Right. So right now it's really hard for this institution to even look at touch stablecoin. There was some hope to have, and there still is, to have a stablecoin legislation in the US this year, which would help and could trigger a new conversation. But for institutions, they just cannot take the risk to interact with something that their own regulator might be totally against, right? Speaking of the SEC, speaking for the US. Now we have Mika, and we'll see how it helps. The feedback I got from Mika a lot during this trip is it's so constraining that it might actually end up against Europe, when initially it was something that everybody wanted in the US and said, yeah, we need to do something to be able to define, how stablecoin can be handled. But if the regulation is too tight, then it works against you.
Yeah, I would say that there's definitely, of course, it depends on the government, right? Like, usually we like to talk about US government. Hopefully they don't talk to me. But at the same time, I think there has been some interest in trying to understand blockchain better. But of course, I would say that understanding better or education doesn't necessarily mean that they're flexible enough to really understand it, right? But I would say that for a lot of governments, as well as the traditional institutions, they'd be interested in having, let's say, different sections, different meetings to better understand, okay, how does, for example, smart contract-based enforcement might work. But I do agree with him that when it comes to, let's say, signing, and this is something that we, for StableLab, we do a lot of the governance aspect, and then it kind of becomes, okay, great, we want to, let's say, work with your DAO. Who's going to sign behalf of it? And the truth is that it's difficult to actually really think about it, right? Now, of course, there are some innovative ways that are coming up, but at the same time, there's something that still is in a lot of discussions. And yes, you can try to convince the government, but I think that your waiter from Belgium will probably come with the bill faster, so it's going to take a long time.
So when I speak with banks, some client I saw just last week, one of the questions when they're not one of those bank issuing stablecoin is trying to understand why their competitor are. And they're like, we just don't get it. We don't understand why. Also, we need to look at what are the alternatives to stablecoin in their mind. And it's tokenized deposit and CBDC more than which stablecoin, because they're not really many at that stage. So what is really interesting, especially if you discuss with this kind of entity, is bringing them real use cases. And also always understanding why you do something, right? Blockchain, at the end of the day, is a database, and there's a lot of things that could be done in a centralized way. The main reason why you would want blockchain is decentralization, which is not necessarily very clear to most of the institutions right now, why you would want decentralization. Some get it, some don't. But then actual use case that make a lot of sense. I always mentioned a public company from France, Metavisio, issuing in Switzerland on the Obligate protocol in USDC. Well, that's a big deal for almost everybody, right? It means that you have companies in France that prefer to issue bonds in US dollar, and it shows really the usefulness of the stablecoin because they could reduce the cost by 75% and do the full deal in a few weeks instead of a few months.
But in this case, they still depend sort of on USDC as a centralized issuer, where to the extent that they use the stablecoin. I guess as a counterpoint, the MakerDAO, for example, has the emergency shutdown mechanism. So much banking regulation focuses on wind down plans. So if something goes wrong with the issuer, what's the plan for an orderly restructuring of the assets and making sure that people don't get hurt? And the idea of having an emergency shutdown mechanism in Maker is that you can define these rules up front and you don't have to depend on a court system to enforce it. So in many ways, it should be recognized as a better alternative than having to wait for 3 years for the bankruptcy court in France to settle.
Yes, I love Maker. Like, I think the idea is great, and they're transforming all the time. It'll get better and better. But when you look at deal like the HVB deal and the type of loan they took, those loans are like based on some conversation I had. They didn't have like an absolute understanding of the type of risk they were taking there. So the quality of the asset of Maker include RWA. And many RWA that are way more risky than treasuries, and they don't always have, the best way to evaluate them. As far as, again, a conversation with Maker, just not my opinion only. and that's an issue, because it doesn't matter if you're a smart contract based only. I mean, the idea is great, but if your collateral collapse, well, it's gonna work against you. Then again, the track record matters. I think the reason why USDT is to the size what it is, well, it's mostly retail, and I include hedge fund and family office, but it's not going to be a big bank using USDT. But USDT is being around for a very long time, and well, it gives you some legitimacy. Now, the more you had very strong DPEG, and for instance, DAI, when they had the DPEG with USDC, I think scared a lot of people, and well, it just makes sense that it limits adoption at the same time.
But that DPEG issue was inherited from USDC for many of the...
Because they chose to have so much USDC in their treasury.
Sure. I guess what I'm getting at is that in the event of an orderly wind down of Maker, you have a smart contract rule that sort of sets those parameters up front. In the case of USDC, had the Fed not bailed them out, essentially, we would probably still be waiting to hear what would have happened with deposits. To a large extent, that sort of illustrates the difference in risk, notwithstanding all of the idiosyncrasies of Maker or any other stablecoin.
Yeah, I think that's one of the benefit of DeFi itself, but also the challenge when DeFi is trying to, let's say, get close to CeFi aspect. And then one of the interesting examples that happened was that, so when the Terra thing collapsed, one of the other companies that was impacted was Celsius. Now, Celsius was also going to the bankruptcy, and the interesting part was that although they were insisting on not repaying the debt to many of their partners, for Maker, they were basically forced to have to repay it, right? Because there's no way that they can try to convince the smart contract because it was there in the first place. So for Maker, although Celsius was one of the largest borrowers during that time, Maker itself was not impacted too much by it. So I think that shows also some of the benefit of those having smart contract, right? Like if you look at even like, let's say Uniswap or Maker, the fact that we can have like very few people, like we're less than like 100 or maybe up to 200 to manage like $1 billion or like over billions of like, those assets and others is actually something that's very unique, because in traditional field, you'll need to have a lot more people to manage such similar thing, right? So I do just think that like DeFi has its own benefit, but as I say, like once you try to get into more traditional field, yes, they can try to understand it, but even beyond understanding, it's like how does it actually work in practice? So like needs time and also persistence, and also a lot of mutual understanding, I'll say.
But in your example here, when Celsius paybacks, it's true, first maker, was it not because it was an over-collateralized loan and they wanted their collateral as totally independent from being DeFi or not?
Yeah, so that was over-collateralized. So but the problem was that
So
for...
they pay back 5 and get back 7.
Yeah, but the thing was that for
that's why
others,
they did it.
you know, I mean, the issue was that for others, even if they had, let's say, those collateral, you know, they wouldn't just pay back, right? Like, or, like, in a
They
way...
would. Like, if I give you back 5 and you give me back 7, they will always do it. Why would they not, if it's centralized or not?
Well, because they can, I mean, the thing is that, sure, like, if, like, it is yes, but at the same time, that also means that because we had a smart contract based on, like, over-collateralization, we are able to enforce it, right? So, like, they couldn't just say, like, oh, based on our, let's say, credit or trust, we're just gonna, let's say, borrow, like, under-collateralized, so.
Maker didn't have to wait for a court to say that Celsius had to repay 1 or 2 and get back 7.
Yeah, so this, yeah, I agree. But the point again is, it was, well, I don't know how long it would have been for courts for this. Could have been a long time, really depend. And that's a good example on how, well, if it's based by a smart contract, but the reason that they pay first Maker because it is Maker, because it is DeFi, I think is not really the case. It's really on, you know, if you have somebody managing the bankruptcy and you just explain the case on, well, we got 200 million there, and if we pay back, they gave us back 500 million, it's going to be approved. So
Yeah, but at the same time, we didn't have to wait for bankruptcy courts, so I guess, you know,
yeah, if it's just for the timing angle, yeah.
Well, I get the other point is that in this case, the code so the reason you need a legal jurisdiction is because you have to have a protracted discussion about how to settle a dispute. The benefit of using a decentralized smart contract enforcement is that you don't have to wait. The rules are understood, and Celsius knew what the terms were before they went in, and those rules were enforced without anyone having to do anything except for Celsius, right? The economic rationale for them to do it was perhaps clear, but in practice, it does mean that they allowed code is law to be enforcement.
Yeah, smart contract are great, yeah.
Coming back a little bit to the point on regulation, and to your point on how MiCA, like sort of the realities of MiCA are settling in, what are the risks for the future of stablecoins if we allow, so much of the financial services industry is essentially a sort of public-private partnership through regulatory capture, essentially. The barriers to entry are so high in the regulated space, and the moral hazard for large systemic banks is so extreme that they can afford to take risks. SVB was fully bailed out, for example, its depositors anyway. What is the risk to the future of stablecoins if, through regulation, we just go back to this world of regulatory capture, right? Like Maker was started by a couple of people in a garage, and you know, some Danish people, some random people, and the barrier to entry was essentially like a laptop. How do you see the risks on the way that the stablecoin industry matures if it becomes over-regulated?
I think we all agree on that one. Regulation will just probably help the biggest institution. That's what has been happening always. If you look at Dodd-Frank, it was supposed to be made to help this kind of avoiding the too big to fail. It did the exact opposite. So again, we'll see how regulation is done. I haven't read like the latest version of all MiCA, but generally speaking, it usually doesn't help the guys that want to launch a new, let's say, stable coin in the garage. But just closing on that, sorry, you also kind of need to define what you want, right? It's like the beginning of the internet. If you want to start Microsoft in your garage today, it's harder than it was maybe way back. Well, debatable, but one of the objectives always sees one of the big difference between Ethereum and Bitcoin is that Bitcoin really care about censorship resistance, while Ethereum kind of decided to thrive and want to get the trillions in. And it's kind of a trade-off. If you want the big institution to get in and you start to get the regulation that allows them to play in and bring those trillions in and bring real tokenization and create new rails for the next financial system, then yes, you'll have what you describe at the same time.
Yeah. No, I mean, I guess my comment, I mean, I also cannot give too much comments because this is more sensitive topics. But I do think that there's, in general, whether that's regulation or not, there has been kind of extremes on both sides, meaning that there are some that are very, very compliant, and then there will be some that they drive more to, let's say, being tried away from it, right? So they like to call themselves like a purist, and that's fine as well, right? So basically, like, don't touch any of the centralized, don't touch any of the institutions, don't even touch like a central exchange, and then, or even go like full anonymous, like nobody knows who they are. And I think everything has pros and cons, but I think that the nature of the blockchain industry has been that there are just like many different ones. And even if, for example, there's regulation, they play around it, or so I think that we'll just see those two different sides, and then whether they're regulation or not, like we're going to see them, because that's just how the industry has been always moving forward.
And then on maybe closing on a more hopeful note for sort of public or permissionless blockchains, we see, as you point out, like the obligate market being launched on a public blockchain, BlackRock choosing to use Ethereum as a public blockchain to launch its money market fund. In the context of Maker, Societe Generale obviously refinanced one of its electronic bonds on Maker, paid it back almost immediately, but it still felt comfortable to use sort of DAI. Do you think the world is in fact can the world move to sort of code as law regime? Would S&P recognize those benefits? Like, how do you see that evolution tracking?
Okay, so first, all opinions are my own, not the one of S&P. But so I think it's really two different things, right? One is the adoption of public chain. The other one is coded law, is law only, because we just had something about upgradability against immutability. So code is not really low because they keep changing the code. But yeah, I think something very interesting is there have been several conferences last year, one of them that we organized, where at the end of the day you had, I won't say any name, but you have a lot of very big investment banks and sell side, and they all agree in general that long term it's going to be on public chain. If you look at Mass and Project Guardian, well, again, I'm the DeFi guy inside the TradFi company, so I'm maybe more biased to your side, but but that's also what I see. It was not what people were saying 2 years ago. Now, something like Mass, Project Guardian, one of the requirements is to be on public chain, right? Because they don't want the fragmentation of liquidity. So everybody in those different entity and TradFi institution understands that there is a network effect by having everything in one place. It's just that most of them are just not allowed to even try, right? So everybody is experimenting in digital asset Canton with Daml, or they're doing their own chain like JP Morgan Coin and JP Morgan Onyx. But at the end of the day, there is this kind of accepted understanding that come back when you ask that long-term public blockchain makes more sense. Now, it's probably going to be public permission still because they need the ML, they need the KYC. But yeah, that's a long-term goal.
Yeah, I'll try to be optimistic as possible. I know sometimes it's difficult because I'm Korean, but I want to add that for DeFi, actually looking into, let's say, TradFi, or TradFi looking into DeFi, although we like to think it from very like institutional perspective, but ever since the beginning of, I'll say, crypto, there was always the element about how they can work together, right? Because at the end of the day, let's say DeFi has the benefit of being more efficient as well as more decentralized, but then it's hard to access users and also liquidity. And then we've been, for example, using central exchanges, which can be considered as more CeFi than DeFi, right? But at the same time, exchanges have very good access for those users, and DeFi, for example, staking or yield have been integrated into exchanges directly. Now, so when it comes to yield right now, and especially looking at, for example, treasury bonds that Maker has been a big fan of, it's like we're able to access those liquidity as well as different users that DeFi itself was not able to. So I would say that it kind of both. Yes, TradFi is maybe like working with the DeFi side, but it's also that DeFi side also has been working and moving towards CeFi as well. And I don't think they're like mutually exclusive.
Cool. Thank you both. It looks like we're out of time. Thank you so much for your time. Thanks for your patience, Charles, with my needling. Yeah.
Thank you.
Thanks.